Okay, now we start with fixed cost variances. So it is actually, you call it fixed overhead variances. Fixed overhead variance, again, there are two. One is called fixed overhead expenditure variance. I will show you on slide. And the other one is called fixed overhead volume variance. Expenditure variance is very, very, very easy. And if, in fact, I would say it is easiest of all the variances. Like if I speak about fixed overhead expenditure variance, easiest of all. Why? Because you don't need to make any calculations. You have given in the data that your budgeted fixed overhead was, I don't know, 10,000, and your actual fixed overhead was 11,000. So you budget 10 and you spend 11. 1,000 is the answer, straight, just plus minus. My actual is 11, my budget was 10, I spent 1,000 more. So that's an adverse 1,000. Pretty simple. In fact, the simplest of all. Then there is fixed overhead volume variance, and that could be complex, a little bit complex. Volume variance means that when you are, when I came to you and I said that, see, I gave you a budget of 10,000 and you spent 11,000. Why did you spend more? You will come back and say, listen, you asked me to have or to spend $10,000 fixed overhead and produce, I don't know, 1,000 units, but I produced more units. I worked more. My answer is, listen, I'm not asking you how much you made, more or less. That's the volume thing. I will talk about it differently. First, you spent more. I gave you a budget of 10,000. You spent 11,000. Your expenditure variance is adverse. This is done. Now let's talk about the volume variance. And you say that you produced more. Now, how do you produce more? When you want to produce more, you've got only two options. I mean, our budget was, we had to produce 1,000 units, but we made 1,100 units. We made 100 units more. How did we manage that, making more? Only two options. One option is that you worked very fast, which means your efficiency was more. Another option is that you did not work fast, but you worked additional hours. Listen, you can only achieve extra production. You can only achieve additional production by only two ways. Either you work extra hours or you work fast. If you work fast, that is called efficiency variance. If you work fast, you said, no, I did work 8 hours. I did not do any late settings, but I was very fast. That is called efficiency variance. And if you said that I was working with the normal speed, but I sat in the evening, I was sitting until 9 o'clock, 10 o'clock. So, I worked more hours. That is called capacity variance. So always remember, in F5, in variances or somewhere else, whenever you talk about capacity variance, you mean that either you are working more or less. So capacity variance favorable, it means that you worked more hours. Capacity variance adverse, it means that you worked less hours than what was planned. So this is the very, how to say, a simple background of fixed overhead variances. This is a figure. I would suggest you people to take, either you write it down on your notebook or you just take a snap, just take a shot of that. I mean, you should be having it with you. You should see it few times so that it remains in your memory. So you've got fixed overhead total variance, which includes fixed overhead expenditure variance and fixed overhead volume variance. And of course, the volume variance, it comes out as a result of either capacity variance or efficiency variance. Okay, so we have got fixed overhead expenditure variance and volume variance. Volume variance, it consists of capacity variance and efficiency variance. And as I told you that you need to remember, now here you have to remember the formulas. Before the variable cost variances and the sales variances, you did very much with logic, but it is better that fixed overhead variances, you remember the formulas, otherwise you may get confused. So let me show the formulas, and of course I will upload it, and you can write it now on your piece of paper, or you can write it later when you watch the video again. So first we need to find out what are the fixed overhead variances. So let me go to the next slide. So one thing you should remember that when you have a marginal costing system, in marginal costing system, fixed overhead variances are very straightforward. You only have expenditure variance. You don't have volume variance in that. Because if you remember that in marginal costing system, we never absorb the fixed overhead. So in marginal costing system, there is only one variance in fixed cost, and that is called fixed overhead expenditure variance. How much was your budget? 10,000. How much you spent? 11,000. That's all, $1,000. You don't calculate volume variance for that. So that's pretty simple, you can remember. But when you do absorption costing, you have two variances, expenditure and volume. Expenditure like before, which we discussed, and volume variances you have to remember. In volume variances, what you need to remember that there are two variances if you remember, capacity and efficiency. So please ignore this thing. You can consider it as, this sign as equals to sign, okay? So capacity variance is equal to budgeted expenditure minus budgeted expenditure. How much you budget? You budgeted $10,000, for example, okay? So budgeted expenditure minus actual hours into OAR per hour, the overhead absorption rate per hour multiplied by actual hours. So this is the formula for capacity variance. And if you see the formula for efficiency variance, consider it as equals to sign. So it is actual hours into OAR per hour minus standard hours into OAR per hour. And if I have to write down this formula, I can actually write it down in an easy format. I can say that OAR per hour multiplied by actual hours minus standard hours. Actual hours minus standard hours. So this is the formula. Now, one thing I must emphasize here, this is knowledge from F2 also. There are three things. Sometimes students, they get confused. One is called budgeted hours, let's suppose. One is called actual hours. And one is called standard hours. Okay, these are different things. So don't mix up budgeted hours with standard hours. Budgeted hours, standard hours are two different things. For example, let me tell you that we create an example. You produce, for example, you produce 5 units per hour. 5 units per hour, and your production is like 1,000 units. So you say that I produce 5 units per hour and I plan to produce 1,000 units. In this case, your budgeted hours are 1,000 divided by 5, 200 hours actually you are budgeting, because you are planning that I'm going to make 5 units per hour. Each unit is taking, I'm going to produce 1,000 units in total per month or whatever time period. And 5 units per hour is the speed. So you need 200 hours to produce 1,000 units. This is called budgeted hours. But then they said that actual production was, I don't know, 1,200 units in, 250 hours. So this is the statement finishes. This is the scenario that this was your budget. This is your actual. And now you say my budgeted hours were 200 and my actual hours are 250. This is your actual from the data. Now, how much is standard? Standard means that how much time it should have taken, how many hours it should have taken. For example, if you consider 1,200 units, so in how much time you should have made 1,200 units based on your standard rate, based on your budget. So that you will calculate like 1,200 units I made actually, and usually I should be making 5 units per hour. So your standard hours are 240. So this is the difference between budgeted, actual, and standard. So when I say OAR, so now if you have, for example, in the same data, they tell you that your OAR is $6. Like your fixed overhead absorption rate is $6 per hour. So how do you calculate your efficiency variance? You would say that, OAR is 6 multiplied by actual hours taken are 250. Standard hours mean how much it should have been. Should have been 240. And then you would say 10 multiplied by 6, so $60 adverse. I'm sorry, $60 favorable, because you made it in less hours. So this is the concept of budgeted hours and standard hours. You should remember that. Sometimes students, they think that budgeted and standard is same. No, budget is what was actually planned. Standard is how much it should be based on actual production, and actual is, of course, what you did. So let me clear that thing again. I come back.
Sir, a standard is based on actual production or budgeted?
Actual production. Standard will be based on actual production, that if actual production is 1200, how much time it should have taken. How much time it should have taken.
Is it not adverse?
So it should have taken 250 hours. 240. Yeah, it is adverse. I'm
40
sorry.
hours.
Yeah. I'm sorry. It is $60 adverse because you took 10 hours more. It should have taken 240 hours, but you took 250 hours. Thank you for correcting. It is adverse.